Welcome to our YouTube channel presenting news, updates and insights from the business world. Today, we will look at a piece from the Economic Times reporting on recent amendments made to the Indian Income Tax Act, also known as the IT Act, in the Finance Act of 2023. Specifically, the Act has altered a particular section, 56(2) Viab of the IT Act, to incorporate taxes for non-resident investments in foreign, unlisted companies, with the exception of Department for Promotion of Industry and Internal Trade, Dept, recognized startups. This amendment has been made to bring the IT Act's valuation rules in accordance with Foreign Exchange Management Act, FEMA, regulations, which requires investors to be issued shares in Indian companies at fair market values, FMVs, set by FEMA. The current rules of IT Act, under Rule 11 UA, also determine FMV of shares in unlisted companies, but they may differ from FEMA's valuation. Due to the change in the IT Act Section 56(2) Viab, overseas investments in unlisted, closely held companies will now be subject to taxes. The current rules set taxes for domestic investors exceeding the FMV of their investments in these companies, commonly known as the angel tax. With the new stipulations, taxes will be enforced on any increase in the FMV of the shares paid to an investor, regardless of whether the investor is a resident or non-resident. These modifications to the IT Act will take effect from April 1st. Market stakeholders have pressed for certain foreign investor classes to be exempted from these regulations. The Finance Ministry is likely to recognize and address their concerns by effectively defining the classes of investors in the rules. When it comes to investments in startups, however, those that adhere to the provided regulations of the Dept will be exempt from taxes. As a practical example of this situation, we will consider a case where the FMV of a share determined under the FEMA laws is 100 rupees, while the FMV calculated according to the IT Act is 80 rupees. If the foreign investors receive shares at 100 rupees only, the IT department will still impose a tax on the difference of 20 rupees. That wraps up our presentation on the new amendments implemented in the IT Act to tax non-resident investments in unlisted, closely held foreign companies. We hope it has provided valuable information on the IT Act's complex regulations for overseas investments. Check out our channel for more news, updates and insights from the business world, and don't forget to download the Economic Times for daily market updates and live business news. Thank you for watching.